Hey everybody, it's Larry Kotlikoff. I'm here with Jonathan Treussard. He's a former student of mine from Boston University. Actually, 20 years ago, he arrived at BU. And I'm going to tell you a little bit about how he got to BU as a PhD student in economics. I would say he was one of my top all-time grad students. I've been at BU for 39 years. And Jonathan, depending on how you do the rating, was either number one or number two. For today, he's number one.
I like it. I'll take it.
You take it. Okay. So, first of all, just to remind everybody, this is Economics Matters, the podcast. I'm Larry Kotlikoff, professor of economics here at Boston University. And if you haven't already, please subscribe to larrykotlikoff.substack.com. You can do so for free. You don't have to pay any money. You'll get all the same thing the people who pay get, but those who pay are kind of contributing to the whole process here of providing economic content to the public. And the podcast has had all kinds of interesting people. This might be like the 40th podcast we started about a year ago, and there's also newsletters, and also a financial Riddler that comes with the subscription. But I've had people like Robert Pinsky, the former poet laureate. He was poet laureate for 3 years. I've had Sebastian Mallaby, writes for the columnist for the Washington Post. Martin Wolf, who is the chief economics correspondent for the Financial Times. Camilla Cavendish, who's a baroness in the UK and writes very involved in policymaking in the UK and worked for Cameron as his chief strategist before he screwed up with Brexit. So really interesting discussions, not just about economics, but politics, and had 3 podcasts about the Ukraine with a political scientist reporter who's Andrew Feziak, who's on the scene in Ukraine. So please do come and check things out at larrykotlikoff.substack.com. But Jonathan,
let me just say before you go on about me, I've been a faithful listener, and it's fabulous. So I'm a full endorser of the podcast, the newsletter, the whole stack.
Okay, cool. Well, it's been fun, and I'm a little bit addicted to it. So more is going to be coming. But let me say that Jonathan arrived, and I don't know how exactly we met. But he got interested in finance. He was in your second year, and so I started talking to Jonathan about his work and his interests, and learned some interesting kind of unusual things, like he ran away from his parents' house in France when he was age 15 or 16?
17.
17, okay. So he hops on.
I did finish high school.
He did finish high school. Guess you had a passport.
That's right.
Jumps in an airplane with his guitar and goes to LA, deciding he's going to make a living as, in the music industry, starting by busking on the streets and living on the streets of LA, which you did for a while, from what I gather. I'm not quite sure whether you actually literally slept on this.
Well, it was a pretty dingy youth hostel run by what seemed to be an openly heroin addicted owner. So it wasn't quite the street, but it was pretty street adjacent.
Yeah, sure. So anyway, so Jonathan's there on the streets of LA playing guitar. He's an excellent guitarist, because I've heard him. And then he decides at some point to go back to school, and he goes to Santa Monica College in Santa Monica, which is part of Los Angeles. And after, I think, 2 years of doing very well in Santa Monica, you transferred to UCLA and started majoring in economics.
Yeah, it was speak about the good grace of strangers. I I was in that youth hostel in Hollywood, which I think is no longer exists and it's probably either torched to the ground or turned into a high-end mall by now. And it was 8 guys. It was only men, 8 guys to a room, and I shared a bunk with a kid from Oakland. And he said to me, "Well, gee," and I had no plan, other than I don't know. I had no plan. And he said to me, "Well, gee, if you want to stay in this country, you may want to get some papers." And I thought that seems like a brilliant idea. And so I ended up going to school because that seemed like the next natural thing to do. And it turned out I loved learning. I learned, I loved the world of ideas. I was pretty good at, school, which is how I ended up at UCLA. And again, to me, that was it. That was dream come true, mission accomplished.
So Jonathan goes to UCLA, graduates in economics with high honors, and then applies to Boston University to our Department of Economics for a PhD. We take him. I don't know whether you told us your whole story in your
with a presidential fellowship, which was unbelievable. I couldn't believe my good luck.
Well, that's fantastic. And then turns out to be our top grad student while he's here, and I think again for many years before. He starts doing highly theoretical finance, not with people in the economics department, but with finance professors in the business school who are hyper mathematical. Economics can be hyper mathematical. And when I kind of started interacting with Jonathan, he was doing financial problems, solving financial issues, and using a type of calculus that I had never heard of before. What's the name of the calculus?
Malevin calculus.
Malevin calculus, which
by the way, is incredibly easy to actually conceptualize once you've gotten your head around it. The whole idea of quote unquote stochastic calculus is to do math on an uncertain plane, right? A whole bunch of things could happen in the future. And so you kind of create a map of the future. You don't know what could happen, and you got to think your way through that maze. And then that gives you one set of answers. And then Malevin calculus just says, well, okay, so there's a whole map of what the future could look like, and we don't know what's going to happen. But what if you shake the map a little bit? What if you just kind of perturb the map in the mathematical language? That's all Malevin calculus is. It's shaking a map of the uncertain.
Cool. Well, anyway, Jonathan graduated, and then you went to work for the Zeff brothers in their family wealth management office in New York. Am I correct on that? Okay, so the Zeff brothers are rich folks, and they had not just Jonathan as an employee, but it was a big office building. I went to visit him in New York, so if you've ever been in one of these places where there's lots of screens and lots of people, Jonathan was managing assets. And then you'll tell us a little bit about the history of the Ziff, not the Zeff, the Ziff brothers, not the Zeff brothers, ZIFF. And then after working with them for a number of years, he started working at Research Affiliates. That's in Newport, right? Newport, and he served as a partner and head of product. He was involved in the firm's product strategy across all the asset classes and across the globe. And he authored the firm's investment beliefs, and he provided a framework for their strategic decisions. And so we're going to be getting some of that knowledge from Jonathan today. The reason I wanted to have him on was to talk about how he views the investment climate and how he views investing in general these days, and also how the practices that are used to help rich people, whether or not they have any relevance for the rest of us, for people that are in the middle class. I consider myself upper middle class, but still middle class, and whether they have some special advantage in making more money and get even richer on, ahead of us because of being able to hire people like you is part of my question. But Jonathan has just launched his own company. It's called Treussard Capital Management, LLC. It's about 2 months old. He's going to be taking on clients. His website is treussard.com, TREUSSARD. So TREUSSARD.com. And you can talk to him in French or English. I don't know what other languages you might speak, but he's going to give you, he's not going to, he's going to work with you. And his philosophy is, if I get this right, that he's not there to advise you, but to assist you, to kind of figure out your particular needs and figure out how to satisfy those. But let me stop here, Jonathan. You fill in any blanks,
the
resume, and then we're going to quickly move to your take on the global investment scene and where you find, where you think about, how you think about strategic, tactical asset allocation, how you work with large family wealth offices, and how that job with the Ziff brothers, what do they teach you? And then this other job with research affiliates, and then what did all that, bring to you in terms of your thinking, and how it connects to individuals, but then how you decided to become an individual financial advisor and go out on your own. Because part of what we're doing here in these podcasts is talking about people's careers, because younger people might be watching this, get to see that, gee, I could start out thinking I'm going to be a great musician and actually be living in effect on the streets and end up being a pretty, successful investment manager, having with a PhD in economics under my belt. And you would never have imagined back in Santa Monica that you'd be here today, right?
No,
So,
I think that's right. And I'll, before I, pick up where you left off, I think it's worth recognizing that I'm such a Larry Kodlikoff fan that somehow I managed to match your shirt today. That's impressive work on our part. We've managed to coordinate.
cool.
But yeah, no, it's been an incredible journey. It's a journey that starts long before I even hit the scene. I'm continually reminded that, 2 generations ago, both of my grandfathers on both sides, my mother's and my father's, were effectively farmers. And so I think that also speaks to, the great fortunes that I've experienced, obviously, but the way in which our system and the opportunities that have been granted to all of us as a result of this great kind of transformation that our economy has experienced over the last 50, 100 years. I mean, and a lot of it is the world becoming more connected, and for, I got on a plane because it seemed like a thing that was doable, as crazy as it was. My grandmother had never gotten on a plane. That was like, a spaceship. So I just think all of this is just unbelievable, and we should.
You have done what you did in what you've done so far in France as well as in the U.S.?
Say that again?
Could you have accomplished what you've accomplished in France or in the EU?
Well, as economists, we know that we don't get the benefit of many natural experiments. So I didn't run the parallel universe, so I can't tell you. That said, I think it's worth being honest about it. I think the answer is no. One of the reasons I left is because I wanted to be a musician. My mother said, great, if you want to be a musician, you need to go to musicology school, and that way you'll be a music teacher in high school, which is fabulous, but felt very limiting and constraining to me. And so I decided to, go down a path in a country that afforded me, the opportunity of really splashing around in the pond and see what would come out. So
You actually, just to be clear, you actually just ran away from home because you didn't tell anybody you were hopping on that plane.
no, my parents were divorced. I had saved a bunch of acorns through high school. I bought a plane ticket without telling anybody, and 2 weeks before leaving, I asked my parents to have dinner together, the three of us, which obviously hadn't happened in many, many years on account of them being divorced. And I said, I'm leaving in 2 weeks. It made for a really awkward dinner conversation, but tears were shed. And ultimately, they said, if that's what you want to do, you got, go do it. Which, again, I think one of the greatest gifts you can give your kids is the gift of freedom.
Cool. So, okay. So anyway, you get through BU and you go to the Ziff Brothers. Tell us about the Ziff Brothers. What's it like to work in that environment? You were there for how long?
6 years, roughly. I started, unbelievably, I started in June of 2008. In risk management on an incredibly complex platform, every asset class you can think of, equity, long, short market, neutral, commodities, private investments, you name it. I show up June 15. My boss says, the first couple of weeks, you're all good. Just learn how to use the phone. And of course, the world was moving too fast in terms of risk on the horizon for that to be an option. So within hours, I was in the thick of rolling up my sleeves and actually helping with managing risk on that incredible platform. So that was fabulous.
So when you say managing risk, is there some kind of, in the context of that family office, was there some global measure of risk, the standard deviation in the entire portfolio, or what exactly does managing risk, does it mean looking for opportunities that haven't been on the radar before or not part of the portfolio?
It means a lot of things, and it means a lot of things depending on what's going on in the world. Obviously, a lot of it is, the important systematic busy work of tracking measures, making sure you know what they mean, things like value at risk and leverage and so on and so forth. But it also, risk management is just an acknowledgement of as I said, for all of the insanity of my career, there's, been a number of common threads, and a lot of it is just acknowledging the world is an uncertain place. We're trying to make, good decisions that accrue to good outcomes, and you figure it out in real time. So it's, again, everything from thinking about things like value at risk to your residual exposure to the market. When you're running long, short, market neutral strategies, you think they're market neutral, but how market neutral are they truly? You may have exposures to countries around the world, and you have a thesis on companies and places. I don't know, I'm just going to use the obvious example. You like Japanese companies. There's this thing called the dollar yen exchange, and you got to think through that, because you may be, missing the whole show if you're not thinking about, the other parameters involved in putting money to work. So that's what risk management is. It's just thinking about the other stuff. My first boss said, always said, the failure of risk management is a failure of imagination. Of course, that's kind of the negative statement, but you get the point. Risk management is about using your imagination to figure out what could possibly go wrong.
And are you looking at like the correlation of, if you were the big Japanese fan, would you be looking at the correlation of the Japanese investment, in dollars, paid off in dollars, with other parts of the portfolio, or would be more of an independent, let's just research this thing? Are there so many investments that are somehow, viewed as uncorrelated that the correlation is not the first order consideration?
In this case, it depends, but again, a big part of it is like, you think you're buying companies, using Japan as an example, you think you're buying shares in companies, but the reality of it is your base currency is not the currency that these companies operate in. So once you repatriate profits, is the way it's actually going to break it down. Those profits actually are bouncing around on the basis of what that currency is doing, possibly far more than what the revenue line and the earnings line of those companies is doing in their own native currency.
And I presume these are companies you couldn't buy directly on the New York Stock Exchange, for example. These must be small.
I mean, yeah, that's an example, correct.
So some of this is like private equity investment. Is that part of what you guys were involved in?
I don't want to, again, this is a fictional example, but it's representative of the bigger picture. I mean, again, that's how we think about those things.
I see. Okay. So anyway, from the Ziff brothers, you go to this company that's involved also in advising. It's a little bit more different. It's different because you have lots of customers, not just the Ziff brothers, and you have to accommodate their interests as well. By the way, how much interaction with the Ziff brothers do the people running the Ziff brothers money? And this is not really about the Ziff brothers, so let's not make it about them, but just in general, do you think that for billionaires, let's say, and I'm not even sure they're billionaires, but for people that are super wealthy, do they get, heavily involved in how their money gets managed, or they just hire people and say, you take care of it, and I'll look at it once a year? Or does it depend on the personality?
Hey, Larry, let me just take a pause here. My dog is barking. You may hear her. So let me just make sure that she's okay and regroup.
Yeah, absolutely. Okay? Sure.
Okay.
No problem. What kind of dog do you have?
I have a wonderful mutt. She's a little bit of everything.
Oh, cool.
Yeah.
Can you show her? Is she right there?
Yeah. Here.
Let's take a look. Oh, beautiful dog. Wow. Very cute. What's the name?
Her name is Bean.
Bean. Cool. That's great. So anyway, so the next job lasted for how long? How many years have you been in?
Same thing, roughly 6-7 years.
6-7 years.
Yeah.
And how was the work different than working with the Ziff brothers?
It was incredibly different, and again, completely unexpected. I left New York. I left ZBI, Ziff Brothers Investments, in 2014. I had gone to UCLA undergrad. I had our twins in New York. I thought moving back to California would make a lot of sense. And I was introduced to research affiliates because they're a large, quantitative, global asset manager. And the idea was for me to join the investment side of things, do quantitative research type of thing. Within weeks of joining, it became pretty clear that my running regressions on their behalf probably wasn't the greatest use of my time. And so I ended up running the business side of the company, the business end of things, as partner and head of product management, which really became a business function. Asking and Research Affiliates is a very interesting shop, about $150 billion of assets around the world, everything done through partnerships. And as a result of that, the question inherently faced by a business function is what to do with whom, where, at what price, and what are the implications of those decisions. If you're going to launch a strategy in this geography with this partner, how does it affect your other business relationships around the world, so on and so forth. And so it was really interesting because, one, I had never been in a business management function. And so that was an incredible education. And again, I mean, you've been an amazing mentor to me. I had another incredible mentor at Research Affiliates, Katie Sherrod, who was my boss and CEO during my tenure. But shockingly, again, a lot of the same, you and I know Bob Merton, and Bob has this saying, which is look for long shelf life principles. And I came across many common long shelf life principles, whether it related to managing a portfolio or managing a business, particularly a business in which basically what you have is a portfolio of strategies and a portfolio of partners. And so a lot of it comes down to the same thing, which is you're facing a great deal of uncertainty as to what, any one strategy is going to do from an investment standpoint, from a business standpoint, uncertainty about call it the quality or the alignment across business partnerships. And so you're trying to optimize, basically, it is not unlike optimizing a portfolio of private investments. So that basically was the job, was to think about, and you mentioned the investment belief side of things. You have to be clear about what you stand for. And so you have to be willing to say, well, I hear you. You want this strategy, but we don't think this strategy is necessarily very good for investors. So, we probably shouldn't be partnering on it together. But ultimately, it is about delivering high quality strategies to a number of parties that then hopefully can help investors, take advantage of them.
So was this job more of investing in particular companies? Is more like a private equity type operation? When you said partnering, was that more of the, or is it, let's say, investing in the Malaysian stock exchange?
No, this is truly again, I learned a lot from, every place I've been, but we're talking about true partnerships where, think of Research Affiliates as almost like an outsourced R&D department, a bunch of, again, kind of regression yielding quants, and they come up with investment strategies based on, long shelf life investment principles. And then instead of, going through the trouble of launching vehicles themselves, 40 Act funds, ETFs, I don't know, limited partnerships, you name it. One of my former colleagues used to say, the world does not need another trading desk. The world does not need another large sales force. And so what the firm does is it partners with companies that have, fill in the blank, the large trading desk, the large sales force, so on and so forth, so that
yeah, I got it. So your partners are the people you're working for are bigger investment companies or other real investment companies, I would say.
I'm not going to make a distinction between real and not real, but
okay, yeah. Okay, but you're more focused on selling the ideas and the strategies and the research going behind it to clients, would be a way of putting it, I guess, right?
Yeah.
Okay. All right, cool. So now why do you decide after 12 years of all this that it's time to become Jonathan Treussard? The name of the company is
Treussard Capital Management.
Treussard Capital Management at Treussard.com. Why did you decide to strike out on your own?
It felt like a very natural evolution, and again, kind of long in the making. I really did love places like ZBI and places like Research Affiliates, and I keep friends and all of the above. But there is something about, look, you're doing the same thing in a circuitous way. There's something about, if you're lucky on a good day, helping people achieve better outcomes, which feels, very tangible and real. And so that to me was kind of the nature of it. When you're in institutional wealth management, institutional asset management, it all feels very removed. When I, through Treussard Capital Management, I'm a fiduciary for an individual, a household, a family office, or a family foundation that doesn't have access to this form of expertise elsewhere. I can actually have an impact in a way that feels very tangible, immediate, personal to them and personal to me. It's a combination of having a skill set which hopefully is of value to people and yields better outcomes, but also just working with people and organizations that you care about.
The human engagement, right?
Yeah, and look, again, I would argue, you are one of the noteworthy few for whom that really matters in a field where many of our fellow PhD economists, never get out of the classroom, never get out of the office, and instead, we all know this is about people.
Yeah, in the end, for sure. So let's switch to move over to your kind of global view of the market. When we first started up or dialed in together, you started telling me about some things that happened today on the banking area. Maybe we should start with that.
Yeah.
PacWest, you said, was bought out.
Yeah, no, so totally. And again, this is what I love about this, and again, the applicability of everything. And by the way, this is the fun part. This is where you and I get to think about things and hopefully educate people. This is not financial advice. That I reserve that to the clients of Treussard Capital Management. So this is really about the inherent nature of the fact that the world is an interesting place, and interesting is often code for really uncertain. And you got to keep your eye on the ball. So yeah, literally before we got on the phone on Bloomberg, the news hit that PacWest I guess had merged or had been acquired. I'm not sure, all these are overly specified words for the fact that PacWest is no more and now is part of a new thing with Bank of California, which, as you know, is the ongoing readjustment caused by the fact that once upon a time we had basically zero or negative interest rates, and in the course of less than a year and a half we're now sitting at Fed fund rates in excess of 5% and likely going up this week, and as a result of that there are all sorts of business models that made a huge amount of sense not so long ago that are completely getting reworked.
Right. So PacBell, do you know how large PacWest? Do you know how large that bank was? Is this like the fifth?
Let me see if I can pull it up. It was not a small.
So far we've had the second, third in the last 4 months, the second, third, and fourth largest bank failures in U.S. history.
Yeah, I mean, and it looks like this thing was billions of dollars.
So PacWest might be the fifth largest or one of the big ones. And for everybody who's not that attuned to this rolling financial crisis that we're seeing, it all started with Silicon Valley Bank failing. They had taken in borrowed money from depositors, both uninsured and insured depositors, and bought lots of seemingly safe tenure or so treasury bonds and similar securities, yielding a very low rate. As Jonathan was saying, rates went up and the value of these things went down. So the value, in the balance sheet, you got the liabilities are here and the assets are down here. So the bank is literally bankrupt, and the uninsured depositors started pulling the money out, and you had a bank run, a traditional type bank run. And then the FDIC, the Federal Deposit Insurance Corporation, runs in and takes over the bank, closes it down, and reorganizes it. That's the second largest or the third largest now bank failure. And then we had two more, and then we had Citigroup, and then we have now PacWest. In the Great Recession, 17 large U.S. financial institutions went under, and only one of them went bankrupt, which was Lehman. All the other ones went under through these kind of shotgun weddings, but there were some nationalizations by the federal government, Fannie Mae, Freddie Mac, and AIG. So these things start to be noticed by the financial community as what you call a banking crisis. We had 7,000 banks, 7,500 banks, I think, in 2007. We now have about 4,300 FDIC insured banks. The whole banking system has more or less imploded over the period since. And now we're seeing small, medium-sized banks getting into trouble because they're like SVB. They all have a large fraction of all these remaining about 4,300 banks are bankrupt if you mark their assets to market. If you really look at their assets, they're down here and the liabilities are up here. And
it doesn't get much worse, right? You've got assets that get marked down because the present value of these bonds has gone down as rates have gone up. And then of course you've got their liabilities, the deposits that are either leaving because there are more attractive places to park cash or are demanding higher returns. And so you've lost on the asset side of things, and you're basically running out of funding on the liability side of things. Those are pretty existential challenges. I don't know how it gets much worse from a business model standpoint.
right. So I guess the question is for the kind of the listener here is whether all this occurs very gradually. With the S&L crisis, we had about 1,500 banks went under over a 9-year period. It was very gradual, slow. It didn't produce any major economic downturn or panic. With the Great Recession, you had people getting panicked when Lehman Brothers went down, when Fannie and Freddie, when AIG, when Merrill Lynch was absorbed by Bank of America. These things were, Wachovia Bank fails, the largest bank failure. That was the number one bank failure. Countrywide Financial goes under, biggest mortgage lender, or they get eaten up, absorbed. So I wonder whether this is going to be really noticed by the public, or whether it's just going to be under the radar, and the Fed is somehow kind of goosing the system by giving, making favorable loans to the acquirer. In the acquisition of Bear Stearns by
JP Morgan.
This was JP Morgan. Yeah, they bought up Bear Stearns for $2 a share. It had been like $187 a share 2 months before. And so they bought it for less than the price of the building of the headquarters of Bear Stearns. And it's only after the Fed buys up $31 billion of the worst of Bear Stearns assets, takes them off the books, overpays for them. So this is the way that the Fed, in effect, gave JP Morgan money to buy Bear Stearns through the back door. So a lot of that must be going on in these things. I guess the real question is whether the public will kind of perceive this as another banking crisis, and whether the uninsured depositors will get even more nervous, move more of their money out of the small, medium-sized banks into money market mutual funds. And then we have kind of not every 2 months, but every day we have another bank fails. And then
I think it's obviously an incredibly complicated and dynamic type of system. You've got the depositors, and whether they view this as another day at the office or a real concern. I think the fact, look, at the risk of drifting into other things, obviously the stock market is doing extraordinarily well, and implied volatility on insuring against losses is incredibly low. I mean, there seems to be a huge amount of calm out there. So it could be that this is filed as another day at the office by the people that should feel affected, but maybe they aren't, because the truth is their deposits are safe. And then there is the whole other side of things, which is, as you said, what does this mean for the plumbing of finance? What does this mean for kind of the societal aspect of all of this? Are we going to be okay? Is this preferable, or is this not preferable from a public choice standpoint? If we have, 3 or 2 or 1 mega bank in this country, all this feels very fraught with.
It seems like a transition away from,
Yeah.
from the Bailey Savings and Loan of the It's Your Wonderful Life to just big banks that are where all the deposits are insured, but they're then so closely regulated because the Fed can't come up with the total amount of insured and uninsured deposits is about 17 trillion. The Fed and the FDIC has no reserves. They probably a negative.
That's it. I mean, the whole thing is, as our system has matured, we've decided to call it that, right? What we've introduced, generally speaking, is more fragility, right? So now we're in a world in which there's so much fragility that, if you can't let it be any other way than, other than successful, because failure is apocalyptic. So yeah, there's that kind of thing going on. But again, I'm not here to. I don't know if we should be alarmed or just recognize that the world goes through changes over time. I mean, again, you and I were just talking about the fact that before we started recording, about the fact that kind of the functions of finance, the functions of markets, always kind of shift back and forth. Functions that were fulfilled by banks might be fulfilled by private credit funds now, and functions that were fulfilled by, it's just all these things kind of constantly shift. The question is, does it shift? Does it break? What happens?
I think there's a concern for breaking, because when you have Citigroup today, Citibank, I forget exactly what the precise title is these days, probably has 70% of its deposits uninsured. And that's probably true for most of the other banks. And all these banks have met the stress test, which means that they can lose like 10 or 12% of their assets can go down in value, but your assets can drop by, let's say 12%, and you still have enough, your assets will still exceed your owner's equity will still be positive. You will not be bankrupt. But if you have the Federal Reserve and a bunch of kind of satellite banks that the Fed is in effect insuring 100% because they're systemic banks, and now everybody in the world decides, hey, this is a safe place to bank. Okay, now you have the potential for Citigroup, for Credit Suisse, right? Credit Suisse had all this.
Yeah, I mean, that's the point. That's the fragility thing that I was talking about. The only escape route is towards more.
Yeah, we become the insurer for the world. There's this big moral hazard. The entire world could say, oh, we can get free insurance in effect by parking our money in these big banks, and then these big banks may become in effect so regulated that they can't do much of anything with respect to financial innovation functions. So it becomes more like a zombie banking system, and then we have, as you said, other kind of shadow banks developing, some of which are leveraged and can cause problems, and some of which are like, equity finance mutual funds, which may be the direction of the whole financial system, because they are at least safe from the institution itself going under, because they're equity financed. But anyway, what else do you see in the financial world these days that you want to kind of tell people about in terms of?
Yeah, I mean, look, again, I think the punchline is very simple, which is, look, I think uncertainty is high at all times. So the idea that, there are safer times and riskier times in a lot of ways is kind of misconstrued. I think we have just kind of underlying uncertainty, and we just have to deal with it. but it does feel like there's a lot on the horizon that could cause things to go kapooey one way or the other. And so I think part of it is just starting with acknowledgement of the uncertainty and making sure that you're ready for whatever the world is going to be throwing at you.
So let me ask you this question. I mean, if you look at the US, for example, our long-term fiscal position, my view is it's like, desperate, that we have massive off-the-book liabilities. The official liabilities are massive. Altogether, the country's about 40% bankrupt in the sense that it needs like a 40% immediate and permanent tax hike. Would you be looking at investing in the bonds of a country like New Zealand, which seems to have its fiscal act together, or even Canada? Is that something that Treussard Capital Management could help people with? If I wanted to, let's say, buy some New Zealand bonds, which I can't do very easily with Fidelity, would I be able to do it with your help?
The answer is yes, but to your, again, the big, it becomes an issue of what is this about? If you're worried about the, Kotlikov household balance sheet for the next 5 years, I don't know how to think about, honestly. I mean, you have to, we've clearly been in this fiscally upside down situation as a country for a long time. And the world seems to be incredibly resilient. It's the same thing. We always think this is untenable, but somehow it manages to carry on just, another inning. So yes, I mean, look, as you think about it, it's an intersection of what your goals are, what your horizon is, the kind of what these assets are for. I like to talk about the why behind the assets. If you're dynastically thinking about, wealth management, then you have to start worrying about all these things for sure. I'm sorry, go ahead.
Yeah, your horizon is certainly part of it, but I mean, are there bonds in other countries that you think are, or let me put it this way more generally, do you see certain parts of the financial asset market as being particularly cheap at the current time? Economists are of the view that nothing's cheap, that everything is properly priced in real time, because unless you have any information that's publicly available will be incorporated in asset pricing immediately. And asset pricing, so nothing. I mean, it doesn't say you shouldn't diversify, but do you think the markets work that well? Do you think
so the punchline on that is, it is my unequivocal belief that the one thing that is for sure is in my view, markets are not efficient because ultimately this is about people, and people are emotional beings, and they get all kinds of wrapped up around their psychology. And so I as much as some economists, I don't think all economists, find comfort in the idea of efficient markets, I would find comfort in the idea of being 20 and having a six-pack forever, but that's not the real world. And so no, markets are inefficient. Markets tend to sway, as the expression goes, between fear and greed. And it's usually a good idea to actually look at valuations, not because mean reversion is guaranteed, but because at least you have a sense of how much downside you might be facing if, the big bad kind of mean reversion wolf comes, out of the woodwork. And so you look at this and, you think to yourself, well, gee, and again, I repeat, this is not financial advice. This is just kind of looking at prices in the marketplace. Whether we like it or not, U.S. Treasuries are offering yields that they haven't offered in a long time. It's probably even more so the case for inflation-protected Treasury securities that are, offering real yields, inflation-protected yields that you haven't seen in, more than a decade now. Earning 2% after inflation doesn't feel super sexy, but those are honest prices in the marketplace. Then you look at things like, corporate bonds, and you're quickly led to conclude there isn't a lot of extra reward to be had in corporate bonds relative to treasuries at this particular point in time, because everybody's kind of not worried about defaults and things like that. So until people are worried, things are usually not, they're not priced great, which means there are a lot of ways in which they can disappoint. The same is true of U.S. equity markets. The U.S. economy and the U.S. equity market as a result has just been getting punched in the face over and over again, and it is still standing. And as a result of that, you're looking at things and you're thinking to yourself, well, gee, this thing is unbeatable. And so prices in U.S. markets tend to be high. You look outside of the U.S. and valuations tend to be a little bit better, and that probably is true in places like, in fact, going back to our old favorite, Japan. This happens to be a time when, by the way, the currency, is such that you're like, well, gee, if there's any normalization in exchange rates, maybe that's, an extra way to do well in some of these international markets. But it's all about, acknowledging that the market gives you prices. Sometimes they're good, sometimes they're bad. Sometimes we don't have a choice. If an investor has a mandate to invest only in U.S. equities, well, gee, that's their reality. I think a lot of, you were talking about the way I think about things. I think a lot of it is acknowledging that everybody operates within a particular kind of sandbox, and a lot of it is circumstances for as I said, the households or whatever, and within that sandbox you're trying to organize things so that they make the most sense. There are a whole bunch of scenarios in which things kind of work out pretty well. So that's the way I think about it. I look again at the VIX, which is the index of volatility on U.S. equities, and it seems shockingly low. So you start thinking to yourself, well, gee, maybe I can buy insurance on U.S. stocks at a reasonably low price. I mean, these are just thoughts that you have to then contemplate given the prices in front of you.
Right. So let me go back to my kind of earlier question about you got a private family office. They have folks like you who can figure out how to buy Canadian inflation index bonds, for example. We have our index bonds, which are, yielding a great return. So at least I would say to anybody listening that this is the time to think about locking in some of your retirement fund just in maybe a 30-year tip and yielding, I think it was yielding the other day, 1.88%. If you go to zvbodhi.com, Zvi's a very close friend of mine. He's also Jonathan's father-in-law. Zvi is a professor emeritus in finance here at BU. So Jonathan met his wife, Moya, through taking a course with Jonathan. That was the method, not the standard track, but anyway, do the rich have a way? They have clearly more opportunities. The transactions costs, I think, since they were engaging in bigger transactions, are lower to buy assets that are not your typical assets. The typical American investing with Fidelity is not going to have the ability to go buy a Canadian inflation index bond through their Fidelity brokerage account, because I've tried it myself, and these people don't have any way of doing that. So, do the rich have an advantage over everybody else in getting richer because they can overcome these, get the expertise, get these that would otherwise not be made? And does it really matter that much, do you think?
No, I mean, I think there's a commonality. I mean, we all, put our pants on one leg at a time type of thing. So I think we all, there are certain things where no one's at a particular advantage. I mean, I think squarely about the fact that everybody wants to, I guess the most transparent and honest way I can say it is I think there are plenty of people that are ultimately selling to the ultra wealthy strategies, funds, things that are special and only for you, but ultimately are just another version of rent-seeking activities where quote unquote the rich ultimately gets taken advantage of. So I think because we're all people and we all want to think that we can do something that we can't. And when you've reached a certain level of wealth, you're accustomed to thinking that things are different for you, and so you think this extends to financial markets and all of that. And in a lot of cases, I think that's not true. So I want to squarely recognize that reality, which it's not. I think there are a lot of ways in which people need, whether you're ultra net worth or just a normal person, someone on your side who actually is a fiduciary to you, who says, hopefully is well educated and an expert, and they say, I've looked at this and I know it sounds good, but it doesn't add up. So there's that reality, but I think that probably is kind of the edge, which is when you have a team of people, when you have dedicated experts, they'll do one of two things for you. They will actually kind of think through on your behalf. They'll augment your own brain cycles, and they'll say, well, gee, that guy who came to you with a bunch of dirt in a remote part of the world, and they say there's riches underneath, it's just dirt. So there's kind of the analytical edge, and as a result of that, the real superhuman move here is to be more rational than everybody else, right? So that's what having experts on your side does, and the other part is, as you said, what you described, which is then you might have all sorts of great quote unquote insights, but if you don't actually know how to put them to work and you don't have the pathways for putting them to work, then great, that was a great intellectual exercise. Maybe Larry Kotlikoff loves Canadian inflation protected bonds, but until they're in your portfolio, they're just a great idea. So there's all of that, but I think it's a really complicated. There is no good answer. The answer is yes, of course, there is an advantage to having dedicated people, having people that hopefully are well trained, have seen a bunch of life. I think there's no other way to learn what a financial crisis looks like than to live through one. I think even Ben Bernanke would tell you he studied financial crises, and until he was, getting punched in the face by one, it wasn't the same. Right. And all of that.
Yeah, I'm as you're talking, I'm thinking about all the rich investors who invested with Bankman-Fried in his crypto exchange.
Yeah, exactly. That's exactly right. It's like everybody wants access. Everyone wants to think there's something better out there. And whether it's, again, the psychology of a person seems to be completely uncorrelated with their wealth. Right. I mean, it's a rich person who happens to be also extraordinarily talented in whatever field they're in. And then they get, taken by Madoff. They get taken by FTX. They get taken by the idea that when you move lending from a bank to a private credit fund, it's like a new thing. It's not a new thing. It's the same function. So there's always a way in which, you can be sold a story.
So I think what you're doing is really extremely well, exquisitely summarizing the value of financial expertise. It's really, if anything, it's kind of keeping your own psychology, your own emotions at bay, under control, letting somebody else think about things soberly. Of course, it's very, very difficult to find people who are actually have the expertise, but I'm really happy to hear that you're in this business, because I may be consulting you for the rest of your days. I may be one of your earliest customers here. And I certainly suggest to everybody listening that they check out Treussard.com, TREUSSARD.com.
And I will encourage, in fact, people to also, again, I love thinking about things. I like communicating things. I like sharing what I think is important, insights. So, subscribe to the newsletter. It's, again, no charge. You'll get emails once or twice a month with, again, I'm trying to, kind of look at the world and say, well, that makes sense. Maybe this is a way to think about it. And, oh, by the way, this one doesn't make sense. And, let's be careful. And so it's, if you can classify things, for all of the, brain damage that you and I go through to try to actually make sense of things, ultimately, it usually is pretty simple. It's, okay, this actually makes sense. This doesn't make sense. This is a good price for a reasonable thing, whatever that thing is, whether it's an asset or whatever. And then, but it takes a long time to get a sense of, being a student. I mean, again, we all want to believe certain things, and then you have to be like, well, we've seen this movie before, and it feels a lot like that old movie, and it's the same. I'm reminded. Let's go back to Santa Monica College. I took an English literature course with a guy who was a screenwriter. And I guess he supplemented his income, possibly during, writer's strikes, by teaching courses in English lit at Santa Monica College. And he always said, look, there's, like 5 fundamental stories in the world. It's like, whatever, Jack and the Magic Beanstalk, and whatever the 4 or 5 kind of basic mythical stories are. And then every other story kind of fits into that framework. And he literally would say, as a professional screenplay script fixer, the studio sends me this thing. I look at it. I decide which of the 4 or 5, stories this is. And if it's Jack and the Beanstalk, Magic Beanstalk, then I fix it so that it actually works, and so on and so forth. So I think a lot of it is just kind of making sense of things showing up and what are they.
Cool. Well, listen, best of luck. We will be obviously in touch on an ongoing basis. And thanks so much for joining us today on Economics Matters, the podcast. JonathanTreussard.com.